Imagine for a moment that you are standing in the kitchen of a beautiful $1.2 million home. The granite countertops are polished, the hardwood floors gleam, and the neighborhood is exactly where you always wanted to live. But as you look at your bank statement on your phone, you feel a tightening in your chest. You are calculating if you can afford both the premium groceries this week and the rising property tax bill due next month. This is the silent crisis sweeping across the United States, and it is known as being house rich but cash poor. On paper, you are a millionaire. In reality, you are struggling to maintain the very lifestyle you worked 40 years to build. Today, we are going to look at a truth that most financial talk shows are too afraid to tell you. We are going to go beyond picking stocks or timing the market. We are going to discuss why your temperament is more important than your intelligence when it comes to your freedom. And most importantly, we are going to show you how to stop being a prisoner of your own property. According to recent data from the Federal Reserve, the average American household approaching retirement has a net worth of about $400,000. But here is the catch that many people overlook. In most cases, more than half of that wealth is locked inside the walls and roof of their primary residence. You cannot go to the grocery store and pay with a handful of shingles or a piece of your drywall. You cannot use your kitchen cabinets to cover a sudden medical bill or a trip to see your grandchildren. Unless you sell the home, downsize, or take on debt, that equity remains just a number on a piece of paper. Many of us were raised with the idea that a home is the ultimate investment. We were told that as long as we paid off the mortgage, we would be safe. But safety is not just about having a roof over your head. True safety is about having the liquid cash flow to live your life without fear. Warren Buffett, perhaps the greatest investor of all time, often says that investing is not a game where the person with a 160 IQ beats the person with a 130 IQ. He insists that once you have ordinary intelligence, what you need is the temperament to control the urges that get other people into trouble. When Buffett talks about temperament, he is talking about the ability to stay calm and rational when the world feels like it is upside down. Think about the story of a famous hedge fund called Long-Term Capital Management. This firm was run by some of the brightest minds in finance, including Nobel Prize winners. They had the highest IQ scores in the room and the most advanced mathematical models ever created. But when the markets moved in ways they did not predict, they panicked. They doubled down on risky bets, and eventually the entire fund collapsed. It was not a failure of brainpower. It was a failure of temperament. If you are approaching 70 and all your wealth is tied up in a single house, you are taking a massive risk with your temperament. Why? Because property taxes rise, insurance premiums skyrocket, and the cost of maintenance never goes down. When those bills arrive and you do not have the cash flow to cover them, fear starts to take over. And fear is the enemy of a successful retirement. Let us look at the hard numbers that the housing industry does not want you to focus on. Historically, American home values rise at an average of about 4% per year. That sounds fine until you realize that over the same period, a simple diversified stock portfolio like the S&P 500 has averaged nearly 10% per year. If you have $1 million sitting in a home that grows at 4%, you are gaining value, but you are also paying for maintenance, taxes, and insurance. If you had that same $1 million in a liquid portfolio earning an average return, you could be generating $40,000 or more in annual income without ever touching the principal. That is the difference between owning a valuable pile of bricks and owning a machine that prints money while you sleep. Many people tell me they plan to use a reverse mortgage to tap into their home equity, but you must be very careful. A reverse mortgage is essentially a bet against your own longevity in the future value of your home. It can provide temporary relief, but it often comes with high fees and can eventually lead to you losing control over your most precious asset. It is often a band-aid on a wound that requires a different kind of surgery. So how do we fix this? How do we move from being house rich to being truly wealthy and independent? The first step is a shift in your mindset. You must stop looking at your home as your primary retirement fund. Instead, start looking at it as a place to live that carries a specific cost of carry. If your home is too large for your current needs, you are paying for space you do not use and taxes you do not need to owe. Consider the strategy of downsizing, or what I like to call right-sizing. Selling a large family home and moving to a smaller, more efficient property can instantly unlock hundreds of thousands of dollars in liquid capital. If you can free up $500,000 from a home sale and invest it wisely, you have just created an extra $20,000 a year in safe, sustainable income. When you combine that with Social Security, you are no longer just getting by. You are thriving. You are now at what we call the second tipping point of wealth. This is the moment when your money officially starts earning more than you ever did at your peak working years. Imagine waking up every morning knowing that your bills are paid not by your labor, but by the quiet power of compounding. This is what Buffett means when he says that the stock market is a device for transferring money from the impatient to the patient. Being patient is easy when you have a plan and the cash flow to back it up. It is very difficult to be patient when you are worried about how to pay for your next repair. As you look toward the next 10 or 20 years of your life, ask yourself a very serious question. Do I want to be the person with the biggest house on the block or the person with the most freedom? Financial independence is not about being a millionaire on paper. It is about having the ability to say no to things you do not want to do and yes to the experiences that matter most. It is about being able to take your family on a trip without checking your balance. It is about the peace of mind that comes from knowing you will never be a burden to your children. The bar to be above average in this country is actually very low. Most people will reach their 60s with very little saved and a lot of anxiety. But you are already ahead because you are seeking the truth. You are learning that real wealth is liquid and real success is measured by your level of control. Don't let your home be a beautiful cage. Take a hard look at your assets this week. Differentiate between what you own and what actually pays you. Remember that compounding only works if you let the machine run without interference. And the only way to let it run is to have enough cash on hand so you never have to sell your investments in a panic. Keep your temperament steady, keep your eyes on the long term, and don't be afraid to make a change if your current path is leading to a dead end. You have worked too hard to spend your golden years worrying about money. Take back control of your financial destiny today. Start by focusing on income, not just equity. Focus on freedom, not just status. If you found value in this perspective today, I invite you to join our community by subscribing. We are here to help you navigate these complex years with clarity and confidence. And if you are currently weighing the decision to downsize or stay in your home, leave a comment with the phrase cash flow. I would love to hear your thoughts and share a few more resources on how to calculate your own liquidity ratio. Until next time, stay calm, stay patient, and keep your focus on what truly matters. You've got this.